Okay guys, so here's the MT4 platform interface. So as you can see, it's made up of a wide variety of features, but we're only going to focus on the ones that we think are going to be very important for you to understand how this app works and how to execute your trades. So firstly, let's start with currency pairs. We mentioned earlier that there are 8 major currencies in forex trading. However, in this platform, they are represented in what? In pairs. So let's say, for example, or to use the first one as an example, it's USD CHF. It's called a pair because it consists of what? Of USD and Swiss franc. So USD is measured against the Swiss franc. The second one there is GBP USD, and there's Euro USD, and so on and so on. So there's quite a variety of pairs here. There's also indices, so you can see the famous NAS 100 there, and then the UK oil, US oil, and a whole lot more. But then for now, let's just focus on currency pairs. So you're gonna use GBP USD as an example, right? So here, the Great British Pound is measured against the United States dollar, and this is represented by this chart here. So forex charts, guys, are price versus time graphs. So here's your price. All these numbers that you see here on your right are price, and then here at the bottom is it's time. Hence it's called a price versus time graph. So each and every forex chart, it's made up of candlesticks, guys. The things that you see here, these things here, are called candlesticks. So there are 2 types of candlesticks. It's bullish candlesticks, these green ones here, using this one as an example, and these white ones there are your bearish candlesticks. So bullish candlesticks basically mean that the market is going up. In other words, this means that GBP is stronger than USD. You can also understand it from a perspective of buyers and sellers. So bullish candlesticks represent buyers, bearish candlesticks represent sellers. So a bullish candlestick will mean that GBP is gaining strength or is stronger than USD, or buyers are in control of the market. They are strong, or they have control of the market over the sellers that are represented by by the bearish candlesticks, which again mean that the bearish candlestick basically means that the Great British Pound, which is the base pair here, is weaker than the United States dollar. So that's how you can understand this candlestick flow. And then it's important to also note that each and every candlestick represents a time frame in which you open or you view the chart with. So in this case, we view the chart from a H4 time frame. We mentioned earlier again that there's different time frames, ranging from minutes up until monthly. So this one is an H4 time frame. Let's say, for example, you want to view the chart from a 30 minutes time frame. You just have to click here and then it will change. So this represents the GBP USD in 30 minutes time frame. One thing that you need to take note of is where this candlestick open and close. So they open and close differently. So let's start with the bullish candlesticks. We're going to use this one as an example. All the bullish candlesticks open at the bottom and closes at the top, all of them. Whereas the bearish candlesticks open at the top and closes at the bottom. So again, this is called the body. So from this point, guys, to this point, it's called the body. And then these lines that you see here at the end are called rejections, or rather they're called wicks. They're widely called wicks. So they just represent, or rather mean that at some point the price was here. For example, let's use this candlestick. This candlestick opened here at the bottom, and at some point it came all the way down here, but then it went all the way up here and then closed here. So it just shows where the market or the price was at some point. And then this one is a bearish candlestick, open here at the top and then closed here at the bottom. So yeah, that's about it with regards to the anatomy of candlesticks. Okay, there's another important thing that you need to note. All the Forex chart, guys, you read them from your left to your right all the time. So we're going to use this as an example. This is the latest candlestick, right? So this means that the next candlestick will form on your right, not this side. So the next candlestick, which will represent H4 in this case, will be this side, will form this side, not this side. So that's what we mean when we say you read the chart from your left to your right. So let's go on to 1 minute time frame so that we deal with the ask and the bid line. So this is your bid and your ask line, right? And then this space here in between it's called the spread. It's called the spread. So it's the difference between the buy and the price, the buy and the sell price there. So what this basically means is that, let's say for example you do your analysis there, and according to your analysis the market will go up, meaning you will be buying, right? So if you're gonna execute a buy here, the market won't open here on the bid line here, it will open here on the ask line here. That's why all the time you go, every time when you open your trade, it's gonna start off from negative. So you'll only be in profits once this line passes that line, this red line. So once this line come on the other side of this line, that's when you'll be in profit. Same thing as you sell. When you sell, your order will be opened here, and then it will only be in positive, or rather in profits, once this line passes this point. So yeah, that's basically about it with regard to the ask and the bid line. So let's move on to market execution. So say for example you want to execute a trade here, you will click here on new order, and it shows you this feature that we see. So it's market execution. Execution, like the name says, guys, it's basically executing your trade, whether you're selling or buying at that point. So it will either sell if you're selling, or buy if you're buying at that moment. So if you want to take a buy, you just click here. If you want to take a sell, you just click here. So let's move on to what to stop loss and take profit. Again, as the name says, stop loss, that's you stopping your loss. So for example, and I will keep on using practical examples because I think they're going to be very important to allow you guys to understand what I'm saying. So for example, stop loss, right? Let's say according to your analysis, you buying here, the market will go up, and then you execute a buy here. But then because you understand that Forex deals with probabilities or works in probabilities, it doesn't mean that always you'll get the direction right. So for example, unfortunately, your analysis was wrong. For example, you say, okay, sharp, I'm taking a buy here, but then should it happen that the market goes against me, by the time it gets here, it must take me out. Why? To protect your capital. So you don't want to lose more. So you only want to risk what? This much. Whether it's going to be 100 rand or 200, whatever the case may be. But then it's basically you saying, I don't want to take any more loss beyond this. So same thing as take profit. Say for example, you say, okay, I'm taking a buy here, but then by the time the market gets here, I want to go out, meaning I want to secure more profits. I want to extract my profits. And fortunately, it goes your way. By the time it hits this point, if your TP is here, then it will just take you out with the profits that you would have accumulated at that point. So yeah, that's basically it about the stop loss and take profit. Let's now move on to lot size. So here's it's represented as volumes, guys. Volume basically means lot size in other words. So you have different lot sizes. You can see this is the minimum lot, 0.01, and then all the way to to 8. That is the highest lot there. So this lot size is basically how they differ. Okay, let's rather use a practical example for you guys to understand the difference between the lot sizes. So say for example, you and your friend here, you do your analysis and then you say, okay, according to our analysis, we're taking a buy here, right? And you all agree. Then you use standard lot, meaning 1. This is your standard lot. And then your friend uses the minimum lot, 0.01. And say for example, you got the analysis right and then the market goes your direction. So by the time it gets here, like on your take profit, if you put your take profit there, you make a profit of 100 rand because you used standard lot 1. Your friend, unfortunately, as much as you guys took this trade at the same time and at the same point, he or she won't make a profit of 100 rand as you did. Why? Because he or she used the minimum lot, that is 0.01. So yeah, as much as it's fun and interesting to use bigger lot sizes, it's actually risky as well, because should the market go against you, say for example you take a buy here and then unfortunately it goes down, so by the time it gets here you lost 100 rand and then she would have lost what, or he would have lost what, 10 rand, because he used or she used the minimum lot and then you used the bigger lot. So in simpler terms, the bigger the lot size, the bigger the reward, but then so is the bigger the risk. Yeah, so that's about it with regard to the lot sizes, guys. Let's move on to pending orders. So we mentioned earlier that you have different types of pending orders. So we have buy limit, sell limit, buy stop, and sell stop. So the limits, or to make things simpler for you, your buy and sell limits are your reversals. So let's use a practical example for you guys to understand what I just said here. So say for example, the market is currently here at this point, and you analyze and say, okay, I don't want to execute the trade now, but then according to my analysis, the market will come all the way down, and when it reaches to this point, this red line here, it will reverse, it will go back up. So you want to put your buy limit. Perhaps maybe you won't be around, but then you don't want to miss this opportunity. So if, for example, you put a buy limit here, which is going to be a buy limit if you're saying it's going to reverse and go up, your order will only be activated once the market comes all the way down and passes this red line where you've put your order there, and only when it returns, when it reverses, will your order be activated. So same thing as selling. Say for example, you say, okay, the market from here will go all the way up until this point, and then it will reverse from this point, and you put your sell limit here. By the time the market gets here, it has to pass this point, and only when it comes back will your order be activated. So they differ from the stops, because unlike your buy and sell stops, once you let's say for example you've put a buy stop here, once the market reaches this point, your order will be activated immediately. So it doesn't have to like reverse first for you to be activated. It will activate it immediately. So is your sell stop. If you put your sell stop here, once it reaches this point, it will just activate your sell your order. So yeah, guys, I think that's about it. I hope you understood what I just said now, and I hope you understood everything else that we discussed so far in the video, and you learned as much as possible from this video. Yeah, that brings us to the conclusion of this video. Please don't forget to subscribe, like, and share. That's it from me, guys. I'm out.